Welcome to RBC's Markets in Motion podcast, recorded September 16th, 2024. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. Two big things you need to know. First, a few things, besides renewed optimism over a 50 basis point cut, went right for small caps last week. Second, we highlight our current top-down U.S. equity market read-throughs from the domestic policy platforms of the Harris and Trump campaigns. The longer-term signal their platforms are sending is frankly more interesting to us than the noise around any shorter-term policy-related sector trades. If you'd like to hear more, here's another 5 minutes. Now let's jump into the details. Starting with takeaway number one, what went right for small caps last week? We met with a number of small cap investors recently who are keen to know our thoughts on their asset class. Our view, valuations are no longer cheap for the Russell 2000, and positioning is back to 3-year highs, though not all-time peaks. And so we think much of the easy money from Fed cuts has been made, and that for small caps to see a sustained outperformance trade take hold, either recession needs to occur when small caps benefit from anticipation of cyclical recovery, or near-term economic tailwinds need to improve. Even if the landing ends up being soft and Fed cuts are coming, something that normally sparks small caps leadership, we suspect a hot economy rather than a so-so economy is needed for this economically sensitive part of the equity market to embark on a longer-term outperformance cycle. So, small caps had a big move on Friday. The trigger was renewed optimism about a 50 basis point cut, but a couple other things went right as well. First, consensus 2024 U.S. GDP forecasts have now moved up to 2.5%. In recent history, small cap outperformance has been associated with an above-average economy, which we appear to be getting closer to for 2024. Also, the preliminary September reading for consumer sentiment on the University of Michigan survey surprised a bit to the upside and rose versus the prior month. This is really good news for small caps, which have been trading closely on a year-over-year basis with consumer sentiment trends post-COVID. Another thing that went right, inflows returned to small cap funds, while outflows occurred from large cap funds, pointing to a deliberate rotation and attempt to move down market cap. However, these shifts were both driven by shifts in passive flows, which keeps us worried that the size trade will stay fickle. Longer term, the shift in GDP forecasts and consumer sentiment data makes us feel better about a small cap leadership cycle. But in the very short term, the flow data makes us worried that if a 50 basis point cut doesn't come through Wednesday, a view shared by RBC's rate strategy and economic teams, the fast money may be disappointed and small caps may take a short-term hit once again. Moving on to takeaway number two, election uncertainty persists while domestic policy views take shape. Uncertainty from the U.S. election persists. Harris has expanded her narrow lead over Trump in betting markets and national polls, while swing state polls for the presidential race remain tight. Interestingly, the S&P 500 has been showing more signs of decoupling from Trump. For most of 2024, S&P performance has been moving in sync with Trump's trends in the betting markets. However, last week the S&P rose as Trump fell. We continue to point investors to the seasonal playbook in election years, which highlights how equity markets usually falter in September and October and enjoy a relief rally once the event passes. Assuming we have a clear outcome shortly after Election Day and a split or Republican Congress, we think that remains a reasonable way to think about how election dynamics may play out in U.S. equities through year-end. While last week's debate did little to provide clarity on the domestic economic agendas of either candidates, which is key for stocks, but investors have gotten some additional information from both camps in recent weeks. We compared the plan posted on Harris's website with the one posted on Trump's, along with his recent economic speech in New York, and outlined our own preliminary U.S. equity read-throughs. For the non-U.S. investors looking for short-term trades to make, and that's really how our call volume has been trending, the playbook we see right now is probably thinner than they'd like, at least according to our top-down approach. We think the conventional wisdom that Harris is better for alt energy and Trump is better for traditional energy remains one of the clearest and most sizable gaps between the two candidates. Political risk to the healthcare sector does seem low to us under both candidates, but we see a bit more risk from Harris due to the focus on costs. Both campaigns have articulated a number of consumer-friendly initiatives, but Harris's platform seems friendlier to lower to middle-end consumers, while Trump's platform appears to be friendlier to the upper-income consumers that have been propping up consumer spending of late. On corporate taxes, we see Harris's proposal as challenging for public companies generally, but perhaps more so for small-cap companies who are more direct payers of the headline rate prior to 2017 than large-cap companies. We don't have enough details on Trump's proposals to properly understand sector and index applications, and found the comments he made in his recent New York speech linking a 15% corporate tax rate to domestic production confusing in terms of what it says about the impact to S&P 500 profitability. While both candidates are taking a tough stance on China and trade, Trump's is more intense. Industrials and materials, two sectors that normally perform well late in election years, were hardest hit within the S&P 500 performance-wise during the 2018 China trade war. The longer-term signals these plans are sending about where the country was headed were, frankly, more interesting to us than the shorter-term trades. On paper, these two candidates are talking about an awful lot of the same things: fighting inflation and keeping costs lower, stricter immigration policy, assisting lower-end and middle-end consumers, pushing ahead with policies that support deglobalization like tougher trade. Housing affordability and supply and education are being discussed by both camps. Language from both camps is friendly to AI so far. Both seem likely to add to the deficit or keep it sizable as well, keeping investors who focus on that issue frustrated for a while longer. Regardless of outcome, these are all likely to stay in focus in the years ahead. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.